Hello everybody, welcome to Monday Morning Must Knows. My name is Merlin Rothfeld and we're going to start things off very differently. Normally I'll talk about earnings, but there really isn't anything that exciting with earnings. What I want to do is touch upon what happened last week. Last week's trading was pretty good, and then Friday we mentioned Jackson Hole Symposium. Thursday, Friday, and Saturday, some big news, and watch out for those central bankers. And lo and behold, Jerome Powell said, hold my beer. I'm going to make a nice speech and scare the bejesus out of these financial markets. And lo and behold, we saw a huge spike down on Friday's trading session based off Powell saying, what? We're not going to slow down on raising interest rates. There's no real reason for us to. We are going to fight inflation, battle it head on, and keep raising rates. So the market was like, oh my goodness. And that, my friends, is where we're going to start. We're going to start with the central banks. Now, why central banks? Well, because the central banks are the ones that are driving this train right now. And if you're bullish, you better be hoping that they're going to be accommodative. If you're bearish, you better hope they're going to be overly aggressive with regards to fighting inflation. Now, there are a couple things that we can look at. One of those that I personally love to look at is the Fed funds futures. This is what traders around the world are anticipating the interest rate hikes going to be at specific points in the future. So let's start things off with the upcoming meeting. Now, the next meeting for the Fed is going to be September 21st. And what you see on your screen here are two bar charts. The one on the left represents the anticipation or the actual contract wagering that the Fed funds rate will increase by 50 basis points. We are currently at 2.5. They're expecting it to jump up to 3%. On the right-hand side, you can see 3.25. That is a 58% chance. So right now, the odds are that at that September 21st meeting, the Fed is going to raise 75 basis points. Now, these numbers will change wildly. This is as of Sunday night, getting ready for this trading week. But you know what, by Tuesday, Wednesday, Thursday, it can change dramatically depending on what the emotions and the feeling are of the trading community with regards to the Fed and central banks. Now, one reason I think this is really important to look at is Jerome Powell's comments that he made last Friday were extremely aggressive. And when we look at this chart, this is from the Federal Reserve of St. Louis. A great resource for you if you're looking for any economic charts. Now, this is inflation versus rates. Now, what you notice is the red line there represents CPI, and that's what we've been using as a measure for inflation. It was up to 9.2%, it recently dropped to 8.5%, but it's still very, very high. The blue line represents the Fed funds rate that we just looked at. Now, what's noteworthy here on this chart, which goes all the way back into the 1950s, is that normally the blue line, which is the Fed funds rate, is higher than consumer price index. It's designed that way. They want to make sure that they keep inflation under control. And throughout the course of history, there have been some times where the red line is above the blue line, but they'll raise rates to correct that. But look at the hard red edge of this chart. This is incredible. Look at the separation there. We don't have any separation in the last 70 years that looks like what we have right now. That blue line is just barely curving to the upside, where that red line is exponentially higher. So one of three things is going to happen. Number one, that blue line will start to increase even more as the Fed gets really aggressive and tries to get that Fed funds rate above that inflation number. Number two would be that inflation starts to drop. We see that red line get lower and lower and lower, and maybe the Fed keeps raising, but ultimately we'll see that blue line above the red line. Or option number three is we don't really do anything and the markets just freak out. That's probably not going to be the answer. My assumption would be that the Fed, based on what they said last Friday, it's going to be much more aggressive, keep on raising rates, and this could be very important for your long-term perspective of the markets as you're building out your portfolio. Now, let's take a look at some other things that aren't just Fed-related, although they did get mentioned in that meeting at Jackson Hole. Jobs, looking at employment data. This is critical, and there are four major announcements happening this week. We'll start things off on Tuesday at 10 a.m. Eastern Standard Time. JOLTS job openings are being reported, which is it's a good one, but not the major market mover. This one here, the ADP non-farm employment change, will be on Wednesday at 8:15 a.m. Eastern Standard Time. This one is extremely important. We get to the unemployment claims, which comes out every week on Thursday at about 8:30 a.m. Eastern Standard Time. And finally, the big daddy, the unemployment rate, will be Friday at 8:30 a.m. Eastern Standard Time. Now, this one's important because right now it's sitting at 3.5%. And if you read through or watched or listened to anything Jerome Powell said in Jackson Hole last Friday, he basically said, look, there's going to be some pain. Job market's probably going to start to get hit. It's okay. We are willing to let that unemployment rate rise in order to get inflation under control. And this had traders grabbing their desks going, oh my goodness, because what this means is if that unemployment number starts to rise, and they're expecting it to happen now because the way they're fighting inflation is going to choke out the economy a little bit. So this rosiness that everyone's been thinking is there and we're all experiencing this great financial move to the upside, that may be slowing down. And there's a danger here because as they fight inflation, there's a cyclicality to unemployment. If all of a sudden that unemployment number starts to move up a little bit, goes from 3.5 to let's say 3.7%, that means you have fewer people in the economy spending, which means GDP starts to decline. Oh, and all these numbers start to decline, except for inflation. So as I look across the spectrum of all the important numbers that we look at as traders and investors, gross domestic product, how is the economy growing? You have an employment data. Do we all have jobs? Are we working? And then inflation, right? How quickly are costs rising? The Fed has basically said, we don't care about growth. We don't care about jobs. We care about inflation. And there's been so much inflationary data coming out in the past couple of weeks that have painted a slightly better picture, but it's still not looking great. So as you approach these markets going forward, keep your eye on inflation data, keep your eye on the jobs, because we'll start to see some turns in these data which could impact your trading. That, my friends, is your Monday Morning Must-Knows. We'll see you next week.